Hey guys, we are back in the studio today with Jeremy Poling, loan originator from NFM Lending, and we are picking his brain on mortgage products, what's happening on the mortgage market, and the question of the day is going to be, what is DTI? It's something that I engage with my clients a lot about. And I'm always saying, hey, make sure that your DTI comes into play with credit scores. So what is DTI and how does it correlate with the loan process?
Very good question. So DTI, one of those industry jargon terms that the home buyers are going to hear throughout the process. Debt to income ratio. What is debt to income ratio? Simply put, it's just your gross monthly income divided by your gross monthly liabilities or expenses.
Now, another question that I get when I'm explaining this ratio aspect, what exactly would be debt? Does a cell phone bill count as debt? Does it a car payment, rent? What counts as a debt? Is it something that you're paying a monthly payment to each month, or do those other expenses come into play as well?
That's a very good question as well. So monthly expenses that report to your credit report are definitely going to be factored in because we verify your credit report at the time of application. Items such as your cell phone bill or other items that may not report to those three major credit bureaus aren't necessarily going to be factored in. Monthly housing expenses, taxes, insurance, mortgage insurance, those will factor in.
That's all going to come into play. And typically that's
child
something...
Support payments,
alimony
payments.
Alimony, child support. Yeah. And then typically when you're calculating those ratios, that DTI ratio, do you use the potential home mortgage as you incorporate that when you're doing your calculations, right? So you're going to take, what your car bill is, what other student loans you have, and then you're going to take that future mortgage payment, principal, interest, taxes, and insurance, possibly HOA, and you're going to add that in, and that is all a determining factor into your DTI ratio.
Correct. We qualify using the proposed payment based upon the liabilities that the consumer currently holds.
And the future.
And then we will use that new mortgage payment, assuming that they've already closed on that, and using that calculation as their qualifying ratio.
Okay, good information. And then from an income standpoint, is this income after taxes?
It is not. Well, depends. That's a very tricky question. Actually, you got me there.
I got you.
For self-employed borrowers, we look at the business tax returns, look at Schedule Cs, we look at all other schedules that they may have reported income on or reported losses. K1 schedules, the 1120 business returns, and so forth. So on a self-employed borrower, we will truly look at the net income reported. There are a couple of exceptions to that where some of the write-offs or itemized deductions can be factored back in to improve their income. So
there's some finagling that can be done. And it sounds like it's pretty buyer specific as to how they're calculated. And it also sounds like that there are different ways or limits that can be adhered to with those ratios. So for each buyer is different, and for each loan product as well.
Each loan product, yes, that is correct. And just to kind of circle back, yes, so the individuals that are paid with a W-2 each year, no 1099 income or non-exempt income, we'll use the gross amount, meaning before taxes. Those income amounts are specific to different loan programs, not to the different borrowers.
So, All right. Well, that's great information. Thank you. Very, very helpful. Helps me, and hopefully it helps some of you guys out there watching. If you have any questions and want some further details as to how that may correlate with you, feel free to reach out to Jeremy. His information is below. And thank you so much for stopping by and watching.
Thank you so much.